Dan, you're a portfolio manager for a media and telecom fund at T. Rowe Price. Now, we've seen a lot of investors flock to telecom names for the defensive nature and, of course, their high yields. Is this play still intact, or is there other places to find value?
Yeah, you're right. I mean, as I think about kind of what's made the group so successful this year for equity investors, I think about it in two factors. One, the fundamental characteristics of the telecom businesses, which tend to be steady, predictable, defensible, as you said, particularly in periods of macroeconomic uncertainty. Investors have a lot of appeal and interest in these types of names. On the macro side, as you know, interest rates are incredibly low. The 10-year Treasury, 1.5% to 2%, historically very low interest rates. Investors really have a thirst for yields. And telecom stacks up very favorably. These companies tend to pay out a high percent of their free cash flow to shareholders in the form of a dividend. And so what you've seen with names like Verizon, AT&T is they've been tremendous stocks this year. In some cases, they're trading at 1 or 2 standard deviations above their historical trading multiples. And so I would say, to answer your question broadly, there are pockets of opportunity that remain within telecom, despite some of the moves we've seen today, but I think you have to naturally be pretty selective. You have to be valuation sensitive. And two areas where we still find a lot of opportunity are cable services. These companies provide the infrastructure. Comcast is one example, Liberty Global another. And then on the tower side, the companies that provide the infrastructure, the real estate infrastructure that Verizon, AT&T, and others build their wireless access services on. American Tower, Crown Castle are two names we own in the fund.
Let's focus in on that cell tower call that you have here, because it's something that I haven't really heard a lot before.
And the reason why we like these companies, and we've actually owned them for many years, is they're a real pure play on the build out of wireless infrastructure, 3G, 4G, but they actually marry that pure play and an attractive secular trend with a really attractive business model. So as we talked about, barriers to entry significant, a lot of operating leverage as well in their business model. Around 2/3 of their cost structure is ground rent. They typically have long-term ground leases, or in some cases they actually own their ground. Their incremental cost to add a tenant on a tower is very low. Quite often there's very minimal CapEx required to facilitate a 4th carrier on your tower going to a 5th carrier. And your ground rent doesn't go up at all. It's not a participating lease that they have with the ground rent provider. So often as a tower business model matures, as much as 90% of the incremental revenue will flow through to free cash flow. So these businesses generate and throw off a lot of free cash flow. If I compared American Tower to Verizon, I think American Tower has a lot more free cash flow generation potential, yet they trade at fairly similar multiples on free cash flow.
And is the growth you're seeing in like an American Tower higher than what you'd expect from a Verizon?
Absolutely. So, you know, Verizon organically is growing their revenue as a company 1 to 2% a year. Their wireless business obviously is growing 7, 8, 9%, but they have this legacy wireline business that doesn't really grow and doesn't generate any cash. A company like American Tower or Crown Castle is another example. Is going to be a mid to high single-digit grower 5, 6, 7 years from now, closer to 10% growth today. So I think these companies have a longer leg of growth.
And is that reflected in the stock price right now, that growth?
I'd say partially. You know, the towers have been very good stocks. American Tower converted to a real estate investment trust in January of this year. Last year it was a great stock in anticipation of that. It's actually been a good stock this year. Crown's been a better stock this year. Crown will not convert till January of 2016. So I think people are now starting to already anticipate Crown converting to a REIT. These companies trade at around 19 to 20 times funds available from operations. The AFFO is a commonly used REIT metric. Okay. So actually I think it's interesting to compare them to other REITs. They're quite attractive. For a REIT-focused investor, I think there's a lot of value to be had in some of these tower operators. The REITs trade on average around 22 times next year's AFFO. And as I said, 19 to 20 times for a tower, which I view as a more attractive business model with more attractive growth characteristics, in a lot of cases I think more durable growth. So I think there's a lot of value. So to answer your question, not as cheap as they were a few years ago. There are a lot, you can say that about a lot of names in the market, but I think there's still some value there.